The Dow's up nearly 150 points. Most of the markets are now hitting all-time record highs. Yet, I keep talking bearishly. That's the markets for you. So basically, on the one hand, we have the long-term view. So if you look at it from that perspective, what's happening now is a shift to the east. So this is the OECD long-term forecast. You know, I'll have the URLs to everything I'm looking at in the description below this video. But basically you can see China's expected to become the world's largest economy pretty soon. In some measures it already is. But this data, this shows the scale of what's going on. So the red line's China, this is the US. The important thing is the qualitative nature. In mature economies, growth is slower. And that makes sense. I mean, if you have a country where, you might not have water, electricity hasn't been fully laid out, it's very easy to see how you're going to surge ahead. You still need to set up basic infrastructure. And that involves economic activity. The people who are going to be getting those contracts, building out those roads and whatever, trains, are going to be making money. And as they do that, the productivity and efficiency of the country improves. And so that's also going to increase economic activity, GDP. So, whilst in a developed country, it's harder. You have to look around and come up with something new to get growth. And so half of the things you try aren't going to work. So you get slower growth. That kind of thing. So in a quick look, we can see, China surging ahead, clearly being the world's largest economy as we move on. We can see here, France, Germany, the UK, because I'm in Europe, in Ireland actually. So you can see, these are a lot smaller. And the growth is a lot smaller. There's also a lot of demographics there. If you have a aging economy, once people are in their 50s, 60s, 70s, they're either retired or not working as much. So, in effect, in more aging economies, like in Europe, like Germany, Italy, Japan, more and more people are dropping out of the labour market. And that's happening in the US also. You had the baby boomer generation. That was the largest segment. And basically, they have now entered, or they are entering, retirement. So the ratio of people who are working to the people who are retired in the States is working to retire is increasing, because the number of people retired. No, is decreasing because the number of people retired are increasing and the number of people working reducing. So that means that, you'll end up in a situation where you'll only have a couple of people working for every person who's retired. So you'll have people who are not working because they're young, in school, getting educated, and you'll have a lot of people who are retired, and only a small group who are working. Now that happens everywhere. So yes, at the moment, China's booming, but ideally, you want the population to grow older. So they're going to have the same issues, just delayed. That's why India should be booming in the next few decades, because it's starting from a lower point, and also it has a very young population. So that's just, the big view, stepping back a bit. So how does that affect things in the immediate term? How come we're hitting record share prices? Well, one of the issues is that you can have record share prices without that much volume. So, which is the case at the moment. So, if I buy a share and for 50% more than the last trade, then the share price is 50% higher. It doesn't mean that I can sell all the shares at that super high price, but it looks like you have a very high price. Why would someone buy at a very high price? Surely the person should be trying to get the lowest price that they can. Well, if you're a CEO, you're kind of judged by your share price. You argue that, look, under my tenure, the share price has gone up by 20%. I've delivered for the shareholder, which is one of your main responsibilities. So what companies are doing is buying their own shares. And and they don't care what the price is. You just buy that share, driving the share price high, and then it looks like you're doing a great job. In fact, since interest rates are very low, the stock market snapped back last month as companies announced an average of more than 5 billion in buybacks each day. So companies are actually going around borrowing money, since interest rates are very low, to drive their share price high. So then they'll get better bonuses, and they must be doing a great job. Here's the Harvard Business Review. 5 years after the official end of the Great Recession, corporate profits are high and the stock market is booming. Yet most Americans are not sharing in the recovery. Okay, well is that what I'm mainly... here you are. Allocation of corporate profits to stock buybacks deserves much of the blame. Consider the 249 companies in the S&P 500 index. During that period, so 2003 to 12, those companies companies used 54% of their earnings, a total of $2.4 trillion to buy back their own stock, almost all through purchases on the open market. So essentially, companies were, any money they were making, they were using to buy their own shares. It's like 54% of their earnings were for that, 37% for dividends, nothing for employees, in effect. So it's a weird world we live in. And we can also see here, that whole back to the economic growth picture. So these different bars are for different time periods. So we can kind of see that the developed economies are struggling to get above 2%. The US, nearly 2.5%, more than 2.5% this decade. Then it's expected to fall back to 2%. And then just a little bit above 2%. So that is higher than for the EU. They're not hugely. That's about 2%. Now remember, if you borrow money, if the US borrows money, which it does, it pays more than the EU. So you could be growing at 2%, but if you've borrowed money and you're paying 1.5%, then how well are you actually doing? You're essentially paying off interest on debt. Though that's probably not fully the case. Demographic wise, the US and the UK are expected to increase their their populations are increasing. But that's a mixed thing. I mean, you have all this uproar in the UK about it's so crowded, the hospitals are crowded, getting housing is hard. So there's a lot of pain associated with just adding more and more people. And for just like a 0.5% or 1% increase in GDP, like that's for the whole country, it'd be interesting to see what is the expected GDP per person. So the main point of this page was that, you can see the huge difference. The fact that, China is growing at 6%. And even when it slows down, it'll be down to, I suppose it'll be down to the US level. It'll be down to 2.5% when it's at 2030. So that's not that far away. India is starting later. It has a younger population. So it will retain a high growth for a long time. But like I was saying with the UK, you will have more and more issues since the country will get more and more people fighting for resources. From a trading perspective, that's not, that gives you a big picture. That's too long term. You can have growth in India and China, but if they're your customers, you can do very well. So basically, since off the top of my head, Germany makes many things very, very well. So with growth anywhere, people will want to buy the German cars and other engineering things. So Germany can do very well since its customer base is growing and growing. The main thing I suppose I wanted to mention here was that conflict between how come we're expected to now, like I'm saying, the developed world has entered into very low growth, 2%ish, and how come the stock market is doing very well? Well, in short, it's complicated, but we looked at the whole share buyback thing and just the sheer scale of it. So the markets are pretty distorted. I mean, you want really your companies to be spending money on Capex, upgrading, updating their equipment so that they have the latest, so that they can make better products, they can speed up, increase their productivity and those kind of things. But they aren't. If you have any links that I should look at, just put them in the comments below the video. Thanks.